All right, good afternoon again, everyone. My name is Tom Dosdall. I work for StoneX Group. Our ag division is headquartered in Chicago, but I'm kind of the resident East Coast guy, so they shipped me down here. And it's my pleasure to be with you all. We chose this topic just to go over kind of market outlook for corn, soybeans, wheat a little bit. And then we're going to touch on some market strategy recommendations at the end of this. I think the big thing to keep in mind is there's no one size fits all for every producer. Everyone's situation is different. So none of this is going to should be taken as advice in particular, but as kind of thought provoking or ideas to get you thinking about ways that, maybe you can use some of these tools. So before we get into it, I did mention futures and options. Since there's risk of loss in using futures and options and derivatives, we also do OTC and structured products. We have to post this disclaimer here. I won't make you all read through that, but general reminder that there is risk of loss anytime you deal with financial derivatives. So this is what we want to go over today. Quick, who we are and how we work with farmers, and how I specifically work with farmers. There you go, market outlook. We'll touch on corn, beans, wheat, and also the big picture, what's going on with inflation, and strategy ideas at the end. Just a quick introduction again about StoneX. I don't know if you all are anybody familiar with StoneX, what we do already, or somewhat. Okay, so we work with farmers basically to manage risk on their bushels primarily, and then it leads to a lot of other things that we do, including capital financing and things like that. We're not a bank, we're not a lender, but we're more like a broker, someone you would think of as a futures broker plus more. We're in 5 continents is what really sets us apart from most of our competition here. So we have offices all around the world. I think it's 70 different countries. So we have boots on the ground, we call it, intelligence in Brazil, in China, and any place that's an important area for our markets. We have boots on the ground. We have clients on the ground there that we're hearing directly from, and then we're relaying that information onto our clients. That's one other part of our business is just the market intelligence and research that we offer out. So we partnered with Farm Bureau, actually it was about right before the pandemic started, on a few things. So, and here I'm touching again on our 4 major kind of pillars. We have a no risk crop marketing program. So this is software that's designed to help you track your profit margins on the farm, and it ties in with any futures products that you may have on there to manage risk. I mentioned the market intelligence, and again, we do ongoing market outlooks and education events, workshops, things like that around the country. All right, so that sounds fine. My job is a little bit more complicated. Technically, on my business card, it says risk management consultant. Sometimes I'm a teacher, so we start off just basics in terms of do we know futures and options. If the answer is no, my job is to kind of help educate anyone who may need that information. We're sometimes a coach. Once you have that basic education, our job is to kind of come in, watch how you operate your business, talk to you, offer some advice, some tips based on what we see on how you might be able to better use something like futures or options or swaps. It's part market analyst. Yes, we analyze the markets and what information we have coming in. We try to determine potential trends that could be developing, as well as identify what risks there are out there. And yes, we do actually place the trades on the Chicago Board of Trade, although we're not, we don't trade for profit. We're not speculators day to day. Ultimately, our job is to help you make sound decisions for your farm and understand all the tools that you have available to help you achieve your goals. So really, it's about adding more tools to your toolbox so that you can hopefully run the best operation possible. So that kind of wraps up the intro part. We're going to get in now to the market outlook, and really the big thing is right now, well, last week I should say, it was the Omicron variant after Thanksgiving. I don't know if you guys noticed, you probably did, but the sharp sell-off on that Friday session as the news broke on Thanksgiving that there was the new variant. Crude oil was down about $10 that day, so it was an easy way to say, well, not that I love my family, but it was an easy way to take a little break and say, sorry, I got to go to work for a little bit here. But it was an immediate risk-off deal that affected all markets, not just agriculture markets, but energy, and also the stock market was down, I think, about 900 or 1,000 points that day. The big reminder, I think, of that is that it is a reminder of the unknown risks. You can wake up any day to a new headline. This one I think happens to be mild. We're going to be we're starting to recover now. Crude oil was up 350 today. I think stock market was up 700 points today. It's coming back, but it's a reminder of the importance of risk management overall, because we don't know when that next big risk factor could be looming around the corner. So we'll come back to that later. Really the other big thing, and this is really the big driver in the markets right now, is the story with inflation. And the chart here that you're looking at shows inflation is running as high as it's been, as strong as it's been in the last 30 years. The last time it was running, so we're running about 6.2% year over year inflation. Hasn't been that strong since 1990. And that was the last update was from the November report. The December report is going to be out later this week. And there is a great deal of interest going to be placed on that in the macro markets. We fear that we could see a number close to 7%. And if we see that this month, it's really going to send a jolt through the marketplace that the Fed is really going to have to act quickly to start raising rates in early 2022 to slow down the inflation. What is that going to mean for markets? Well, higher rates is obviously, it's intentional slowing down of the economy. So expect, not only if you have variable rates that you're exposed to from interest standpoint and the effect that could have, but it should slow down housing. It should slow down demand. So it's something we should be aware of going forward. But in general, inflation means that money managers, Wall Street, the people who pour into our commodity markets to support the price, they want to be owning hard assets now, especially going into year end. They want to be able to show their clients that they have exposure to commodity markets. So I think it's for now something that's supportive of our prices. This is just a look, okay, another chart here at Fed tapering. So when we talk about Fed tapering, we're talking about them pulling back on their bond buying program. And that's going to happen first, followed by the higher rates. Any questions on anything about like inflation or macro markets? I'm going to get into the commodities here now and keep moving along. But in general, that's kind of the lay of the land. So wheat right now is the market leader. Do we have many wheat growers in the room? Couple? All right. So, you know, it's really the high protein wheat that's in demand around the world and where we're very short on. And we're going to, and corn, I think, is taking a cue from what happens in wheat. It's a little bit more of a follower right now. This is the big picture. When it comes to the wheat market, the biggest thing I hope you take away from this, and that is that we're at record tight world stocks to use on an exporter basis. Okay, we can look at world supplies and we'll see China in there, but they're not an exporter. What matters is the exporter stocks to use, and that is record tight. So the market is very sensitive right now to any supply risks in the wheat market. Over the last couple of weeks, Australia was a major focal point. Their high protein wheat, especially in eastern Australia, it's been way too wet. It dried off for a little bit, and now they're getting another 3 to 4 inches of rain here over the next couple of weeks. So this is something that was very bullish for price. I'm going to get into a slide in a couple here that actually kind of cooled that story off a little bit because they wound up coming in, the government, with a higher than expected production estimate report. So that sort of slowed that down a little bit. But we're going to have to be watching the U.S. plains also. We're very dry heading into the winter, especially the southern plains. You see out into Colorado, those areas as well. We just don't have room to be short on crops. If you expand that drought monitor up into Canada, really we had I think the worst year in Canada since 2007-08 this past season, and supplies are down sharply up there as well. This is just a table showing some of the recent supply numbers out of Canada, and it just hammers home it was that spring wheat that really was down hard. You see right here down 40%. Durum, but that's a much smaller degree. Spring wheat down 38% year over year. So 16 million metric tons versus almost 26 the year prior has a really strong effect on the market. Over in Europe, developing dryness in the Black Sea region is also something that we, and I think the trade in general, is going to be paying very close attention to. So you guys know the kind of the breadbasket here is going to be right. This is the Black Sea region right here. So we got a lot of wheat production right here, southern Russia, Ukraine. So we got to watch for developing drought over that area this winter. So those are all possible, potential bullish drivers of the wheat market, which could lift corn behind it. A couple of things that were limiting factors here. We had the Omicron thing that happened on Thanksgiving. Then we had Australia surprise the market last week. This was on the Monday we came back from Thanksgiving with an estimate here, 34.4 million metric tons. So that was raised 1.7 versus last month. And it's currently 3 million metric tons above the current USDA estimate. So that was a surprise to the market. There's more wheat in Australia than we thought there was, but it's really wet over there. So we're struggling to still figure out exactly how much wheat is coming out of Australia. And I should say, Canada also, this was just on this past Friday, this report was viewed as mildly bearish for wheat. Canada's production came in at 21.7 million metric tons. We were expecting to see a number around 21.2. So that also came as a surprise and sort of as just something that was capping the wheat short term. Yes, sir.
When's their harvest in Australia?
It's right now. They're about 25% complete. 25, about that, yeah. So the rains are delaying harvest, and concerns about quality are what's coming up.
Yeah, we did not like wet wheat.
Right. Yeah, exactly. So that's a very good question. Thank you. I'm sorry I didn't mention that. Strong world demand for wheat. So the inflation that we were talking about is not having an effect on world demand. Folks are not yet rationing how much bread they're eating, or how much whatever baked products they're eating. Flour demand is still very strong despite the high prices, as evidenced by Egypt's recent demand last week. Egypt's the world's largest importer of wheat. They just had their biggest daily order since 2008 last week for around 660,000 tons. So they've kind of been holding back, waiting, I think, to see if they could get some lower prices. Well, they couldn't wait any longer. So the demand is still there. Large order. Saudi Arabia followed that up with, close to 500,000 metric tons. Now there is rumor that U.S. hard red winter wheat is going to be included in that. So sorry for the soft red guys. But soft red's following hard red. That's kind of the story of this market right now. The reason why U.S. could finally be getting included in some of this business is the fact that Russia, the exporters, will not guarantee supply out beyond April timeframe because of the floating export tax rate that they have out there. So if you're wanting wheat in that kind of second quarter, third quarter timeframe next year, you're having to go elsewhere. There's also rumors that China's in the market looking for Australia wheat. I just wanted to point this long-term price chart out. So we all saw on the wheat chart.
Hey, sir.
Yeah. Oh, yeah, please.
What's this, Russia, are they trying to, or are they levying a tax on their own?
Yeah, so they have a floating export tax, and I think that's my next slide. It's the next slide. They have a floating export tax to try to control the domestic price. The biggest fear for what you might call an authoritarian type regime is runaway food inflation. What's one way to get people to overthrow the government or to fight back strongly against the government? Well, if they're very hungry or they can't afford food. So they're trying to control the price of food in Russia by assigning this export tax. So as the price of wheat rises, that export tax is getting larger and larger and larger. So right now it's around $75 a ton, and I think we could see it around 100 pretty soon.
So they're doing it to keep their own wheat.
They're doing it to keep it in their country. Yep, and so it's having an opposite intended effect on the world price, on the price discovered in Chicago, because we're having less wheat reach the world market, and it's putting more pressure on other exporting countries to fill that world demand. So we're seeing that global price continue to rise. So it becomes like a cash basis story in Russia, really. Yeah, that's exactly, good question. So that's exactly what we just wanted to point out. Hmm? From an export standpoint?
Well, from the standpoint of who's going to supply and when things up about that.
I don't know that there's much talk about disruption to that, to the wheat trade from the European Union right now. But so I don't think I could probably comment on that. It's just not something that, yeah. What specifically that the UK is going to be holding more of its own wheat, and the EU is going to be, yeah. That's an interesting situation. Not one I know much about at this point, but something to follow.
Are we, you guys see us in danger due to our shipping problems? Yeah, shipping problems, ports, California, I guess. As far as people are going to start, our customers, our overseas customers are going to start saying, hey, look, we can't depend on you guys to deliver.
No, because we're really seeing that as a global problem right now. It's not just here. It's everywhere. And so tracking our export inspections report, there's no sign really of major disruptions in our trade, in our ag trade right now. Yeah. This is a big thing though. And one of the reasons why our clients who are selling bushels at harvest time this year, say of corn, for example, or if you're all sold out of wheat, or if you've been forward contracting wheat because it's good prices, you got to be aware of what's developing here geopolitically. I think with Russia and Ukraine, Russia's got 100,000 troops right now on the border with Ukraine. President Biden is going to have a phone call with Putin tomorrow. I don't know how that's going to go, but he's staging 100,000 on the border with Ukraine, and they're moving heavy military equipment at darkness, at nighttime. There's the Secretary of State has made mention, basically sent warning, turned off alarms, to everyone, to NATO, to our European allies, that it feels like Russia's getting ready to make a move into Ukraine militarily. Ukraine's own defense intelligence agency told the Military Times last week that they have the intelligence that suggests that this is going to happen in January. So Ukraine is we talk about the high food inflation, cost of wheat in Russia. Ukraine's very fertile ground, right? Not saying that's a reason to go and take over a country, but you know that Putin, whatever you want to say about him, probably understands the score, I think, a little bit. Add to the fact that Europe is completely beholden to Russia for its energy needs this winter, and you could see why this may be a short-term thing if they're going to do it, because NATO and Europe are completely dependent on natural gas to flow from Russia to Europe. If Russia makes a move here, Europe is in a very weak position to defend itself, in my opinion. The last time Russia went into Ukraine was in 2014 militarily. Hard red winter wheat, that time price spiked, I should say $2, despite what were plentiful stocks at that time. Natural gas jumped $2. So we go back to that same chart again. Here's when Russia went into Ukraine in 14. We went from 6 to 8. Here's where we sit today, around the low 8s, low to mid 8s. When we're at that record tight exporter stocks to usage, the concern is for sharp risk to the upside if something were to occur with Russia and Ukraine. That's a reason to, I think, have call options. If you've sold bushels of corn, I think it's a reason to have some kind of call option strategy or futures strategy with limited risk to kind of keep some upside potential opportunity available behind cash sales that, from this fall. So I'll get into that a little later. That's all a what if. It's all pure speculation, but something you gotta understand. It's good, please.
I'm an auctioneer, I guess to come back. Anyhow, I heard an analyst, not very long ago, that said, you know, if you sold your corn and you're not happy with the price you sold it, go ahead and buy it back. And how's that work? How do you do that?
That we should spend some time together because we could probably do a whole meeting, a whole hour-long meeting on that. But the bottom line is buy futures or buy a call option or a call spread. You'd have no, a put option is to put options to protect a floor. So when you're long the market, when you have unpriced bushels, you've got all the risk of that price going lower. That's when you would want to consider owning a put option because it sets a price floor underneath you. It's like a safety net. So where if the market goes down, it's going to pay you. A call option is just the opposite. It's going to pay you if the market goes up in a specified time period. Or a futures contract is just the same thing as owning physical corn, but it's the same penny for penny risk and reward. So if it goes up, a call option is a little different. You pay a premium and maybe it's 15 cents. And that's your maximum risk. And you have unlimited upside opportunity, but it doesn't pay you penny for penny. If corn's going up 20 cents, that call option is not going up 20 cents. It's maybe going up 3, 4, 5. So you're part of it until it starts going up a lot. Then you're getting more and more with the call. Futures are going to give you penny for penny. So that's going to give you the same exact risk as if you bought back your bushels. And futures, correct. Futures require margin to hold. So like for a 5,000 bushel contract of corn, for example, you have to have $2,000 in your futures account as its collateral, right? Because the price could go down. You have the risk of it going down. So you have to always keep that same amount, 2,000, on deposit when you're in futures. If it goes up 20 cents, well, your account is marked up $1,000. If it goes down 20 cents, your account's marked down $1,000, and you still have to maintain that $2,000 minimum collateral. So that's where you'd be having to send in $1,000 margin to stay current if you're just operating on, using minimums. No, you can pick any month. So depending on how on futures, yes, it's whatever. Yeah. No, I mean, you could, I guess, synthetically do it if you sold a call and did something like that, but that's getting complex. But no, if you're buying it, you're always buying it at whatever the market offer price is that day, at that time of day. That's where you're getting in. So
you already sell it and it's already gone, or you still have possession for it, but it's already contracted?
Well, what I understand, when you sold it's already gone.
But you were asking about buying the contract back.
Yeah, I was just listening to an analyst saying it's,
Okay, so you're not in a position to actually doing so now. But
what I've seen a lot of guys do at harvest time, they're up against storage costs coming. They may have to pay commercial storage, right? And so the question is, what's commercial storage? What is it, 5 cents, 4 or 5 cents? I don't know, around here. What you guys? And you got that, right. You got that initial drop fee plus a monthly. Yeah. So owning futures would be a substitute for paying commercial storage because you can avoid those storage costs. As long as you've got that margin available and you're comfortable with the financial obligations required there, you could totally avoid those drop fees and those storage fees. Just sell it, cash it, sell it cash to them right there, turn around, buy the futures on the Chicago Board of Trade. And it's as if you're owning, it's the same risk reward on the board price, right? If the market goes up or down, but you're not paying those storage costs. So especially if you wind up sitting on them for 6 months, I mean, and at 4 cents a month or whatever.
in some cases, that's the space, it's going, but you're not happy with the price that's going up. You got contract there for that time.
Yeah.
And then you have the right to resell it.
So I think what those guys are doing is they're turning around to their futures account and they're just putting that trade on and, charging a fee to do it. And I think what we're telling you is you can do it yourself and, and save that fee. But hopefully that answers your question. I'd be happy to give you more detail. I mean, we could get very much more into greater detail on that for you. If you'd like after the meeting, you're welcome. Okay, so for corn, here's the deal. Like there's not much carry in the market right now, and the premium's on the front month, right? There's not much carry between December and, December just went off the board. March to May, say, for example. There's little incentive to store bushels. The board is not telling you to store bushels right now. It's telling you to sell it. And the basis is telling a lot of guys to sell it as well in many places. Farmers are holding the grain right now because of these high input costs. We're just not seeing those who have storage are storing it, right or wrong. They're storing it. The market is strong though. The demand is there. They're trying to get these bushels to the market. And the only way they can do that is through a strong cash basis and through a strong nearby futures price. The reason they're holding it, I guess, is just what I'm pointing out here. And this is just showing you the new crop fertilizer to corn ratio. And what you can see is the red line is the current year. And we're just I don't have to tell you all this, but we're way out of whack in terms of how expensive fertilizers are. This is just a map. One of the things we put out on our website here for you to see is it's showing you the difference on the cash spot basis from the 3-year average and across the country. And we update this every few days. Anywhere where it's yellow or green here in the Midwest, you want to be mindful of that. That's 20 to 30 cents better than the 3-year average on the cash basis. So that's how hard they're bidding. That the cash merchandisers are bidding to get farmers to sell that grain. How's the basis here? I know we don't have a dot here, right here, but what do you guys right around here seeing? 40, 50. Yeah. How's that compare to say 3 years ago? Pretty consistent, you say. Yeah, they're trying to buy the grain. Yeah, well, that's the way you see it is you first see it in the cash basis. That tells you what the vibe of the market is, what the mood of the market is strong. Then you'll see it in the calendar spreads on the futures. So studying the relationships, how much carry is there in the market? Is there 8 cents a month? Okay, there's some incentive to store. Is it tighter than that? Yes. Okay. And then the third thing to come is usually the futures price to rally. So yeah, I think that's, yeah. And what we counsel our clients on or coach them on is just to not get caught up on the fact that, yes, the basis is strong. Does that mean you should abandon risk management on the bushels? No, right? We still want to protect that price because something like that Omicron times 10 could always come around the next corner and we could be caught flat-footed. So we don't want that to happen. But for now, that's.
But at what point do you have to start taking into account what happens as that last Thanksgiving? Then markets just start taking off and everybody's throwing money in the market, pushing it around. What's keeping that from not happening moving forward and be able to take that into account?
Well, there's definitely strong reason to still be bullish the market and still think there's upside opportunity. What I think the opportunity though comes in is there's grain out there. It's stored. It's on farm, and everybody's waiting for a higher board price. And I think what we'll see is when we get to a certain level, I think a lot of our clients have this $6 mark in their head. When we start getting there, I think the base is going to start to weaken up because those bushels are going to start coming to the market. And so I think for staying ahead of the game, we like selling into a strong cash basis when it's in front of us and then re-owning it, like you said, either with a future strategy or on call options as a way to keep some upside opportunity open. So I'm not, did I speak to what you were asking exactly or I miss it?
A lot of the purchasers for the end users give the impression that they wouldn't be surprised if once we were throwing money into the market again and try to push it around, especially after the COVID.
Yeah. what I'll show here in a couple of slides is how much money is already in the market in measuring that against historical perspectives. What we'll see is that the managed money, the fund position in the market is already it's the biggest long position in the market that we've ever had for this date and time since we've been tracking it. So it's about 336,000 contracts. So I think all that tells us is that they're here. They're already here. Could they get even larger? Yeah, absolutely. But what will the effect of higher rates have on the economy also as we go forward into next year and on demand? Do we slow down demand, and does that then, start to recirculate? Do people start taking profits out of their long positions that they may have, say, in corn? That's a risk that we have. But ethanol demand is strong. So this is part of what's pushing the basis. I mean, the feed demand is consistent and that's strong as well. But what I think is a really good, that didn't make it in here. I had another chart that I must not have clicked save. I put in there today. It shows the ethanol crush margins, and they were about as good as they've been in 8 years. Going back a couple months ago, it was around between 30, 40 cents a bushel. So extremely strong incentive. And when you got that wide profit margin on ethanol, you can afford to jack that big cash basis up a little higher, right? Because you're still making money. You're still making good money if you're ethanol. What we noticed here the last couple of months is that profit margin is coming down now a bit as oil price has come back down. So they're still profitable, but not as profitable. And so the basis, I think, has cooled off a little bit due to that. But it's going to follow, where we go on the energy markets. Right now, it's a kind of a mild winter, right? I mean, it's 65 degrees outside right now. Energy prices are not going through like the worst case scenario where we feared it was just going to be frigid. Energy prices were going to be soaring, and that probably would have given more of a lift to corn if it were, but we're not seeing it right now.
Last 3 years, due to that drought, the cattle states and the wheat belt, same that area I'm talking about. There's been a huge sell-off in cattle for the ranchers to stay in business.
Yeah.
And which as feeder cattle they're selling. They're selling cattle they want to keep. That baby calf.
Yep.
And this is huge. And I'm an auctioneer that friends out in Wyoming have auction houses. They're calling, they tell me about it. And then they look at it, on the commodity report. The cattle's got a 2-year swing.
Right.
Unlike poultry and hogs, different deal. But this lack of cattle on a huge, a massive number, they don't even know how much yet.
Right.
I think it's really massive from what I'm hearing. How's that going to affect the corn market? Because there's not as many cattle to feed, they're not going to eat much corn. It's just double the farm what I do.
Mm-hmm.
And you're not talking about that today, but how high is cattle?
Well, we're going to need it. We're going to need to export more corn, or we're going to grind more into ethanol. We're going to need to do something with it, right?
Do you think that cattle is going to affect this corn?
I'm very bullish. The feeder, for those reasons you just said, yeah, the price of feeder cattle ought to be going higher for this first and second quarter of the fall or of the spring.
On the cash market.
Yeah.
Feeder cattle hit December 15th or there. Hit 205 100 week or 600 pound head at Vintage Sales Day, which is a pretty large market for us. New Holland's the largest livestock market east of Mississippi for us here. That's big. They're hitting huge numbers there. Those markets are unique anyway. Good to the Mennonite community, different types of farming, so on and so forth. But they're already surging ahead of the basis on the local livestock market. But that's really not what I'm asking. What I'm asking is if there's less cattle in feed, it's going to be on feed because it can't be on feed because it's not there if you had. Do you factor that? Do you see that as a heavy factor in the corn prices?
It's not being talked about much. I can tell you the people who are buying corn, the fund managers, they're not talking about it right now. No.
situation like that happens, like happens all years back, when the price goes up, what they'll do is they'll keep cattle in that trap. So they'll use like coal, you know, they don't have to let 200 pounds off. Shortage, prices up, so keep it all the time, modular stuff. If there's less of them, they might feed them next fix.
Well, we are selling 1,700 pound cattle now,
And how do you get some
you know, in our markets here.
how do you get them that to feed them?
And keep them on.
That takes that kind of self-correcting. From what I've read, to a degree.
Yeah. I think that's well said and good discussion. I think that's well said. No, I think that's exactly right. They take them to higher weights. Now, to what degree does that compensate for the loss? Yeah. Yep.
Yeah, get you there. Bigger cattle are in the last few years. Ben was to sell premium tugs. I mean, you get premium great cattle.
Or that might be because it's not there's a lack of. Say, like, say you need a 20 cow.
Correct.
But even with 5% more, now you're not down to
I should introduce you to our livestock guy too. I think you'd like him very much. Yeah, that's great conversation, guys. No, very all intelligent. I'll tell you with the cattle clients we have too, when they're forward contracting now, the margins are great for cattle, despite this corn price. Margins are great, but what they're still doing is after they're forward contracting and locking in this good price, they are definitely calling us up and very interested in owning call options for the what if possibility over the first and second quarter of next year that we keep running higher. Because I think there is still, I just think personally, I think it's a short term, a little bit seasonally, it's a tough time of year right now, the next few weeks, but I don't know. I think cattle kind of follow where the stock market's going. That's my simpleton analysis also of that market. Okay, for getting back here onto the corn. I just want to show a couple of reminders. Some of these things get through the news without people noticing. So I just want to mention that Mexico just announced it imported 14.6 million tons of corn in the first 10 months of the year. So that's stronger than last year by 7.2%. Not a surprise. I mean, we were dealing with COVID last year, but good. You know, Mexico is our largest destination for corn leaving the country. So we want to be aware of what they're doing. Is their demand stronger or weaker? There was some talk about them banning GMO corn. I would just let that just go over for now. I don't think that's going to happen. So China, okay, so they produce a ton of corn, right? Most of it they consume domestically. Now they have a record corn crop, reportedly by the Chinese government. If you believe them, they've got a record corn crop there right now. Yet the domestic cash price is rising during harvest time. It was a wet harvest, especially down in the regions near where a lot of their livestock are. And so we're seeing demand from China to Ukraine right now for corn, which has the market's attention. And I think that's providing corn some underlying support. Higher domestic prices in China. It makes sense for importers. The margins are there for them to be importing corn right now. Why not the U.S.? Why Ukraine? They don't like the U.S. reporting system, is the rumors that we're hearing from the cash trade. They don't like how we announce it to the world every morning that they just bought a big load of corn. Now, they'll buy it if they have to, but it's when it's coming from, it doesn't really matter for the global price, the benchmark price, whether it's coming from Ukraine or whether it's coming from the U.S. Chicago will treat that as a sign of China demand and the price. You see the rallies. You know, I think we were up like 9 cents one day last week, and that was on specifically on rumors of Ukraine order from China. They're also going to announce their tariff rate quotas. So the government says, "What's your, you know, what That's your subsidy basically. And they're going to announce that by the end of the year for what importers, what they're allowed, how much they're allowed to import essentially. So we'll watch for that. Here's just a quick update on how we're doing with export sales. Good, not great. You know, we were front loaded with a lot of new crop demand when prices were a little cheaper. So the progress that you see here, these bars got built up actually like way early in the year, like way early in 2021. So we're still doing okay. We're still ahead of the USDA's pace. That's what this orange dotted line is. We're still ahead of their pace to meet the USDA exports, which are on their balance sheets. But we've been not lighting the world on fire either here lately with new sales. Another story you want to watch here for the corn market is the building dryness in South America. So they had La Nina last year. They had a drought, which really put a dent in Brazil's corn production, especially, so they grow two crops, right? They grow a big soybean crop right now, they're growing it, and they've got a first corn crop in the ground. After they harvest the beans, second crop corn goes in, that's their big corn crop. La Nina is really a December to February, March phenomena. So we're going to be watching to see how does it second crop corn specifically, how's it going to handle La Nina if it does play out like last year. So right now the maps are showing kind of a lot of the same ocean temps and things that we saw last year. So we want to be mindful that there could be an impact to the second crop corn. And there's really no premium in the market right now, in my opinion, to account for that possible weather risk. This goes back to what we were just saying a little earlier. I think you were asking about, you know, managed money, or we got on that topic. So here's one of the things that from a risk standpoint, those are the things I think could drive us higher, those kind of demand things. Here's some of the risks that we face is the fact that managed money is already holding about 360,000 contracts long in the corn market. As you can see here, that's as long as it's ever been for this time of the year, as long as we've been tracking it. When we're not in tight supplied markets, anytime you see managed money, so you guys know, anybody hear of Commitments of Traders report? Does that ring a bell? Is that every Friday, ever since the Dodd-Frank in 2008, traders are required to report, large traders are required to report their positions, and their brokers are required to report their positions to the federal government, not individually with their names on it, but you get classified as a commercial, as a managed money, or as a fund. And we get those numbers updated every single Friday. And then we put them into a graph like this so we can see, okay, how are they? So our data only goes back to 2008 when that was instituted. But traditionally, when there's plenty of corn out there and we see the funds this long, we want to be hedging. We want to be protecting our floor, because the risk is you get one story that comes along, and it's like a boat when everybody's sitting on one side and you hit one little wave and everybody can topple out. And you saw it with that Omicron event last Friday. And one little news story and you could have a sharp correction lower, because these people, they've accumulated, a lot of them have profits in their positions. They don't want to risk their profits for unknowns or uncertainties. So we're at risk of unknown or uncertain events ahead that could cause this long position to want to take profits. And even just coming back down to here could do a big number on our price. I have no idea under what event. Is it, you know, does China invade Taiwan? Is that going to be a problem? And then are we going to have to get into some kind of, that would be the biggest risk I would see, is just a real risk-off environment with a major geo conflict, right? Something like that. That I don't know how long, you know, it took us a long time to fight back from the trade war tariffs too. So I'd hesitate to speculate on that and give you an answer. I wish I could, but it's hard. Sir?
Question on understanding who's on the other side of that. I think the futures and options, is that commercials on the other side of it?
This is just their net position. This is just their net position. So it's verse even. So there's the other side of the trade could be anybody. It could be another fund. It could be another fund manager. But what's the net what's the net position? How many long versus how many short? And we track these, we break them down by commercials. That's a different category. Commercials, swap dealers, what are some of the others? Non-reportables. I hate to get bogged down in this. I think the point that we want to just understand here is that there is a lot of money in the market right now. And the risk is that, and yes, it can get bigger, of course, but it also is a risk of coming lower. I think the other lesson is when you see that they're holding the big net short like this, 2020, what do you want to be doing in that situation, right? I mean, I want to be owning calls. You know, if I've sold my grain down here, like last fall, right around harvest time, and I saw that they're at basically a record short position, you better believe that's another incentive for me to want to replace or re-own those bushels. Because there's really, what's the risk? How much lower could it go? The greater risk seems to be of it going much higher, which is going to drive the price higher. So this is something, this comes out every Friday. Yeah, if you don't track it, it's something I would probably offer to you that just have some awareness of. That's one of the things we basically share with you as well. One of the other factors is, all right, we're having a lot of talk about these fertilizer prices, and I think general consensus has been that we're going to see a lot more soybean acres next year and a lot less corn. The current fall price ratios in 2022, I'm speaking like for the heart of the Midwest guys, they still favor corn. It's still at about 2.2 to 1 is the ratio. So despite the high fertilizer, all our economists inside the StoneX still estimate we're looking at around 91 million acres of corn. And if you have another trend line, I mean, a trend line or a better yield next year, we're at 2 billion-ish ending stocks next fall on those types of acres. And if you do a little history, you go back and see when we're around 2 billion bushel ending stocks, where it's priced, well, it's usually in the fours. Now, that's not, the big variable is this inflation story, though. But if you just look at those types of ending stocks, there's risk if we have those types of acres. Now, there will be fringe areas, I think, and not, I shouldn't say fringe, but perimeter around that heart of the Corn Belt that'll switch. And other markets, cotton, I mean, oats, if you're up in the northern plains, I mean, everything is strong right now. So there is a lot of competition for acres. I don't mean to downplay it, but to really see soybeans over corn, you want to, that ratio needs to be like up in here to really start to see that acreage change. So it could still change between now and spring, but.
With our government, their infinite wisdom, just and that may be partial, impartial, or negative. They put tariffs on imports of NPK, from other countries to us. And if our government, wants to tax imports of fertilizer, which I think they're getting damn close to trying to do. How's that going to affect things the way you guys see it?
Well, you'd think yields would be down, right?
You need an next time through.
I'm not a fertilizer expert. I mean, we've got a guy who's really, really good at fertilizer, and I would defer. I would not want to answer that question because I am not a fertilizer market expert. But I got to get you in touch with Josh and my livestock guy. So I'm going to hunt you down after this. Good question. No.
You said something about the inflation in relation to what the price are you informed for once inflation might ensure into the commodity prices where over the decade it never did? Kind of push the value of that up.
I believe in the sense of inflation means prices of everything are rising, especially hard assets.
In the past, no matter when everything else goes up, commodities don't seem to rise with it in a consistent basis and hold it there to protect profit.
Hmm.
The argument could be made that that's already happened. 20% of US dollar pretty good last year. If you take the price of say 550 going right now, we're talking about 60%. The argument can be made that that's in that price right now. It doesn't mean it is. I've read online exactly what it's called.
Well, I'm just, you know, a lot of people want to look at these times in comparable to the 80s. Now, I know it wasn't as profitable back then, but there's just as much consolidation, you know, things are going up in cost. And in reality, the margins have improved. So I'm just looking at it from that perspective.
Everything rises together, but those inputs take a long time to fall. The board price could fall quick, but I mean, I think we were talking about that earlier, right? Will it stay here? In other words, is that the question? I mean, is that the heart of it?
Well,
No.
about the inflation,
I think it's.
I'm just trying to.
I think you got to remember that part of that rally too is not just inflation. I mean, it was supply driven too. We were genuinely tight on supplies, and we needed higher prices to ration demand, especially in soybeans. They really shot them up there last winter, and that was supply driven. I think not just inflation driven, but you know.
What the country like this would even great livestock would even generate their own sort of think about it, that is justifying using a higher price commodities to substitute not be able to get the corn fertilizer long term.
Well,
If the bottlenecks continue.
yeah. Why?
Not every part of the country has that ability.
Right. No, I mean, I think bottom line is I don't know how it's going to shake out. My job is really to help. We all know when it's real, and when it's real is when you sign those bills, I think, for those high inputs. And what it comes down to, in my opinion, is making sure the way this really gets upside down is you have high inputs locked in and the price drops for whatever reason. And it could do it. I mean, we could poke holes in it. I'm not going to sit here and say, no, price is well supported here. You know, I think it's the biggest risk is getting that wrong because that's pure speculation. I don't think we know how it's going to play out over the coming 6 months, 12 months. But if they raise rates, the intent is to slow down the economy, to cool off inflation, right? That could have a negative effect on demand. One could speculate on that. So I think it's incumbent on us to manage the price and protect the price on the bushels for next year when we do have those inputs locked in. We should have the price also protected, at least on a portion, in my opinion. So we talked about sales earlier. This is just a chart showing inspections. So I think I said we're doing okay on inspections. That means bushels leaving the ports, but we're lagging the pace a little bit. This is a chart showing how we're doing on corn leaving our export terminals. And obviously the hurricane slowed things down. We were kind of off to a slow start after Hurricane Ida in the Gulf. We need to pick up the pace. We need to be moving a bit more corn physically out in order to meet those USDA estimates, or we risk them trimming it back on the demand side. This is just a look at how we look versus the last couple of years. I mean, we're tracking that chart pretty closely. So I think that's.
Separates what may be going in containers on the ship rather than on the ship on the side.
Going into containers on a ship versus going into bulk. I've not seen that type of data, no. Anything else on corn? Soybeans. Biggest thing I think in the soybeans market long term is this move toward biofuels. It reminds me a lot of corn and when ethanol, it changed the game in 07, 08. And I think that we're in the process of kind of restructuring the soybean market over the next several years toward biofuels as well. And it's going to have a lot of unknowns at this point, how this will all play out. But one real world example here I just pointed to was last week we had this flight from, I think it was Chicago to Washington, D.C., 100 passengers. It was like a Boeing 737, and it was 100% biofuel. First time ever in history in one engine.
Right, with my test pump, just in case.
Last week, one engine. I thought the whole thing was 100%.
One engine, I'm pretty sure it's one engine.
The big deal.
One engine.
Oh, okay.
Just a safety.
Okay. Oh, maybe one engine?
No, the other engines had regular fuel, one engine had bio mixture with it. And it was going with test pump, in case something went wrong.
Well, and the CEO was on board. I didn't know about the one engine versus multiple engine deal. They made a huge PR thing out of it when they got here, right? And I think the CEO went to Congress and he was pushing for the Build Back Better and the biofuels. It has credits in there for biofuels and jet fuel. Yeah. But this industry is really, I mean, they've been investing in that for, I think, probably 4 or 5 years, if not longer, but it's finally starting to pay off. But this industry, we're, like it or not, I mean, it seems like that we're moving in this direction. And it just reminds me of the ethanol industry when it was in its infancy. Here is a chart. I love this chart because it shows you our current capacity for crushing for oil. Here we are at 21, right? We're right around here, down around maybe 100 million barrels per day. And where we're projected to go over the next 9 or so years. This is where we're projected to go based on existing regulations. We're going up to, well, close to 300 million barrels per day, so tripling our existing production. And here's what, if you include some of the proposed regulations, we're talking about quadrupling or more. It really would revolutionize the soybean industry, and we're going to have a lot of meal to deal with. We're going to probably become an exporter of meal in this country, which would be different. But we're currently in the process of building this new capacity, and it'll be interesting from a legislative standpoint. We'll watch and see how this goes. But just, I think, 15%, if they did 15% biofuel in in the airline industry, in jet fuel, huge. I mean, we're talking about completely changing the game here for soybeans. And this is just from USDA's balance sheet showing some of those numbers. Here's what we were importing last year and this year, around 302 million pounds. There's what USDA is projecting, 21, 22, 450 and 450. So over the next, that's the October and November report. We're projecting an increase to 450. So we're needing to import a lot more soybean oil right now. Here's what we're penciling for demand, biofuel, around 8.8 billion. USDA is projecting this up to 11 billion starting next year. Obviously, our ending stock, and we're talking about ending stocks going from around 2.1 billion down to about 1.8 billion. So we're just illustrating the fact that USDA is, the balance sheets are starting to account for the fact that there's going to be greater demand for soybean oil. So that's long-term, you would think, positive, supportive for soybeans. Domestic crush margins, when we fall, the margins are great. If you're a domestic crusher, look how good this is. If you're in central Illinois, we're about $4. If you're over in Iowa, you're about $3. Look at that compared to the historical 5-year average. So the margins are fantastic. So that's why if beans drop, I mean, yeah, bushel. Pretty good business to be in, I would think. Yeah, that sounds right. Thereabouts. Really, really good. China demand is lagging. I'm going to show one. There's another slide here. So this has been a headwind. This is why corn's been following wheat. Beans have been kind of the dog. Beans just can't get it going. And I'll talk about why in a second here, but this is one big reason why is China demand has just not been as strong lately. For whatever reason, either they had enough in reserves, they stocked up, or they're just holding out, waiting to see what kind of crop Brazil has, and maybe there's going to be a lot more to choose from. But they're certainly not seeming to live up to the phase one trade agreement and the commitments that they had in that. I mean, this chart speaks for itself here. We want to see better China demand. And we may start to see it soon. This is a chart showing their crush margins. So you could see, I mean, I don't think well, that hasn't been updated in May 21. So they were positive here for a bit, and now we're just back here right around even, just going positive again on the crush margins. If you're in China, you're just starting to make money again, crushing beans. There was a major energy deal there. Yeah, that's exactly right. Yep. Don't know that number. I think thereabouts 50 bushel. Any of you guys know? I don't know. This is what changed the soybean. This is when soybeans really started to stall out. It was after the September 30th quarterly stocks report, because USDA went back and they increased yields from last year's crop. So we went from having at the time, okay, we were expecting, trade was expecting 174 million bushels or so is what we had on hand last year. Later that afternoon, that number was 256. I mean, that was a much, it's still not a humongous cushion, but it's much more breathing room than 174 was. And where we were at one point earlier this year was around 120. We thought we were at pipeline minimums. In reality, we weren't. So market was very strong. We found bushels from last year that we didn't know were there, which is kind of frustrating in a sense, because if we had the right numbers all along, we wouldn't have been rationing demand, right? The crushers weren't buying some of that because the price was so high. Well, the price was so high because we thought we had no beans. The beans were there. If we knew they were there, the price would have been a little calmer. It would have been, we would have chewed through some more of those beans, I think. But yeah, for meal, it's a problem. The meal would be a problem, I think, on the feed side. Yeah, and it goes rancid. You can't store it, right? I mean, you can store oil for however long, but you can't store that meal. Yeah. Very good point. Oh, I have a duplicate slide. Okay.
Before I thought of this, processing corn into plastic. I think alternative viability.
Another good question. I am not one to speak to that, though. I just don't have the knowledge on that industry. No, or like for car seats, or yeah, it's a negligible. I wish I had the chart on here showing corn use, and it is, you know, the feed, the ethanol, and then the exports, and then everything else. It's like on that graph, it's so small. It's at this point a drop in the bucket. So until we see something really enough to move the needle, I don't think it's going to make much difference one way or another. And I'd just be speculating on where that industry is heading long term, and I just don't know. On the beans, where obviously the yields came up here as we got later in the year too. Turned out with a pretty good bean crop, so that helped boost the balance sheet as well. Now, so we were talking about being 176, then 256. Now we're at, in the last WASDE report, 340 ending stocks. We're doing a lot better here now, right? We're building a base of support. So this is a a limiting factor. You're not going to, if you're a trader, you're just probably reluctant to chase soybeans higher right now in the short term. China's probably not going to do it. They know that they probably know what our balance sheet is, and they'll wait until prices are lower to where they'll show up with the demand. So we don't have a real big bullish vibe here on the soybeans market right now. The other thing is our export window closes by late January. Brazil's already offering cheaper beans by end of January for export. So, and that's not uncommon. I mean, that's what happens this time of year. We start to hand the ball over. Unless they have a production problem, we don't see it right now. Right now, they're expected to have a record crop, 145 million metric tons. So, it looks like if you got beans, I mean, I'd be either hedging them. If you're sitting on inventory, I think I'd be hedging them with a put option maybe underneath. If not selling them and just turning my risk over into, if I was still want to participate, into something like a call option. So. Any other questions or thoughts on that, on soybeans? We're going to get into a couple. How are we doing on time here? Oh, we're running late. I'm sorry about that. All right, so we're going to get into. That's all good. If anybody has to run, or is everybody's still awake, I think so. We're doing good. Don't mind hanging around. Here's just a couple takeaways, right? So. This is more for like an audience who doesn't really know about options. I kind of go through this deal. Would you like to have protection against adverse price levels for the commodities that you have on hand, as well as opportunity to capture better price levels? Well, the answer is options. Just going through the dry definition here, we would say a put option represents inventory insurance. So it's a financial derivative which conveys the rights to a buyer to sell an underlying asset, in this case corn or soybeans we'd be talking about, at a specified price and over a specified term for a limited risk, market determined premium. Why it matters, why we think it should be part of the toolbox, is it allows for unlimited opportunity to improve on your net sale price of that commodity in storage, right? You still have it, markets go higher, you still have full opportunity to participate in that higher market, but you have certainty underneath you where your price floor is. You know it's at. The equation is where your strike price is. Call option is just the opposite. You guys know this, so let me just skip through this part. It's just the opposite. Represents upside opportunity after you make a cash sale in its most simple terms. So let's go through an example here. So it's the level at which you set your price for. Okay, so strike price. We all know that term, strike price. All right, so it's right here. Here's your price ladder. I think we've got the March corn calls on the board right here. I mean, we could just go over some examples right here and skip the definitions if you all want. Are you guys, people sold corn? Was there sales at harvest? And, if you're looking for a way to participate in the market, a $6 call is offered out here for what, 19 3/4 cents. If you're sitting on bushels, if you have bushels in storage and you just don't want the price to slip, I mean, a 550 put option is offered for 11 cents. I'm going to skip through that. All right, don't worry about that. That was in case we had some newbies here. These are good tools, all right? Here's our strategies we're talking about. Okay. And if you guys are comfortable, I'll tell you what we're doing more of. This is kind of like a 101, like starter re-ownership strategy. If you all are comfortable, I'll tell you more of what I'm seeing with our kind of clients who have some experience with it. But so you sold cash bushels, right, from old crop. You still want to participate in the market for all the reasons we just went over. We'll see how those cards hit the deck. You could buy a May call option will get you all the way till April. So here's what we're looking at on the strike prices. Here's what the premiums are. If you're looking for something under a dime, you got to go all the way out to $7. One way to cheapen that up, do a call spread. Buy the May $6 call, maybe sell the May $7 call. So you're buying yourself $1 of opportunity in the market for 30 minus 8.5. So it's 21.5 cents. Limited risk, that's your max risk, and you have dollar of upside in case something hits the fan. Say that Russia story, for example. I think that would probably be the one that would drive that type of a move. If you're now, anybody, I mean, are you guys comfortable with futures? Can I give you a futures example? Say you buy futures, okay? The May price, I did it today. Oh shoot, I don't have it. I know March was around 581 at the close. So let's just say May is at like 585. So you buy futures at 585 if you've sold your corn, all right? You buy futures at 585. Maybe you want to, I don't have the puts on here. Say you want to buy like a 570 put option to protect the risk on your futures because you don't want to have that unlimited margin risk. You could buy a 570 put, sell a 520 put spread for, I want to say it's like around 15, maybe 18 cents. So you're protecting the risk on the futures that you own for 50 cents down for about 18 cents. And then you could go up here and maybe sell a call option out here around like 650 for close to 17 cents. So you're buying the put spread for 18, you're selling a call for 17. You're net spending around 1 cent or so on the options. Your risk would be from between where the futures price you get in at, 585, and where your put spread starts kicking in, which is 570. So you got 15 cents of market risk there. And then you're protected for 50 all the way down to 520. If it goes below 520, you're open on the risk again. In exchange, we're just setting a sales target on our futures that we're in at from 585. Well, if it gets to 650, I'm going to start losing on that 650 call, whatever I made on my futures. So I'd be up 65 cents on futures. I'd be happy to walk away at that point. That's what that trade example would represent. Questions on that one? It's getting late in the day. Call me afterwards. We could do that one. New crop. Okay, new crop corn. So anybody, have you guys started marketing new crop corn? Or are you starting to think about it now that you're getting into the winter mindset? You don't want to tell your neighbor what you're doing. That's okay too. All right, so we're starting to have the conversations. Most people haven't done much at all because of these high inputs, right? But they're starting to think about it. Because I think the real risk is, like we said, you lock in these high inputs and then something happens to the price on the bushels. Something we don't know, something we can't we're not speculating here on it. We just want to protect it. So here's an example. If you wanted to sell forward, I'd say 20%, 10% estimated production. If you sold it forward, either with a cash sale or with a futures contract, we're right around that 550 price right now. But it's so early in the year, you're like, there's too much unknown. We can still go higher. We'll buy a call spread, I think, on off the May 22, for example, and see how the next 5 months go. So something like, maybe something like just far out. You just want to participate if there's a big spike move. Maybe you go out, get yourself like a 620, buy the 620 call for 25, sell the, I don't want to do that one. Maybe sell the 680 call for 11. So you're in for about 13 cents. You're buying yourself like 60 cents of opportunity there. It's going to help you tack on. If you sold 550 and if the market rallies through the spring, you're still going to have, what? We said 620 to 680. 60 cents of profit potential on that, minus your 13-cent cost. Max profit would be 47 cents. So you could still take a 550 sale and turn it into close to 6 if the market keeps going higher. So, again, I don't know if it's late in the day, but we could get you more information on that. Point is starting to move off some risk. Another way you could do it and still keep some upside open is just do one of what we call floor ceiling type strategies. Buy a put, sell a call. So for new crop corn right now, you could set a floor at 520 by purchasing this put option, call it 38 cents, and selling a 620 call option for 31 cents. I'm paying 38, I'm collecting 31. My net cost is 7 plus the trade fees, and I've got essentially a floor at 520 and a ceiling at 620 off the December 22 price. I'm open on my physical bushels. I haven't sold any physical bushels, done any forward contracts or anything, but I've set a minimum price at 520 until next December Anything below there, that put option is going to pay me. And I've set a maximum price at 620. Anything above 620, I'm losing on this financial product, but I'm still holding my physical bushels. When I eventually contract them, it's going to be even if it's 650, right? I'm going to be losing 30 cents here. I'm selling 650 cash corn minus my 30 cent here. It takes me back to that net 620. Floor ceiling kind of deal. We're starting to see some interest in that, and a number of clients, you know, after they lock in their fertilizers, saying, "I got to do something. I just can't get run over here if the price drops." So something like that, under a dime, has been pretty popular. Here's just the same numbers on beans. I've seen for new crop soybeans. Forget about old crop, I guess, but on the new crop, we're at about right around 1240, I want to say, 1235 maybe. Say I wanted to protect, just do something simple. An $11 put, I guarantee myself a price floor on November 22 soybeans at $11 for 33. Yeah, but that's $1.50 of market risk between here and there. I want something closer. Maybe I want to buy the $12 put. Yeah, wow, it's 68. Okay, how do I cheapen this up? I don't want to protect from 12 to 0. I just want to protect from 12 to 10 because I'm going to have federal crop insurance at some point starting to pay also. Market's tight enough. I only want $2 of protection. So I'm going to sell that put for 12 and a quarter. So that gets my cost down to 56, not 68. I'm buying $2 of protection. Then what can I do out here? Maybe I'm willing to sell soybeans at $13.60. I sell that $13.60 call, we could get 45 cents coming back in. So if you're with me, 3 parts to this one. Buy a 12 for 68, okay? Sell a 10 for 12. I'm down to 46. I'm selling a $13.60 call for 45. So I'm laying out 1 penny. And I've got $2 of risk protected here on soybeans all the way till next fall. $12 to $10. If we go through 10, I've made $2. I have cash bushel risk below 10, but I've got $2 in this derivative, in this put option. If we go to 1360, it's like I'm a seller. I have risk there, but you have physical soybeans that you're selling at 1360, and we can always buy a call also on top of that later. But I think something like that makes a whole lot of sense, as well as we go into next year, as you know, with the way that Brazil's crop is looking and what we could see for U.S. acres. So it's giving yourself just control. You're just controlling your price outcome, not trying to predict the market. So the most common mistake we see related to grain marketing is speculation. Way too much speculation. I think we, are very used to buying insurance on everything in this business. But for some reason, when it comes to the price of the bushels, guys just kind of don't pay as much attention to it. And you may argue it's the most important thing to have insurance on. It's what drives your livelihood. So what's common is speculation. It's human nature. I don't know what it is. The markets are interesting. I think that's part of it. But we don't know where things are going to go. Our job ultimately is to understand the market risks and what the opportunities may be. But end of the day, it's to, like I said, control price outcomes, not predict. These tools, I think, give that to you. And sleep happily at night, by the way, with our friend there from MyPillow. So I actually drove down here with my MyPillow in the car. Highly recommend. So with that said, I hope that gives you an idea of what we do, gives you a little bit of market outlook. Sorry, we ran a little long, but if anyone wants to hang around for questions, I'm happy to hang around as well. Anything immediately on mind? A couple of things we offer if you're not, if you're not ready to open an account and use these products right away, we do provide market intelligence, this kind of research on a daily basis. As a Farm Bureau member, you get 10% off our packages. Just let me know if you want any more information to see what's offered out there or to get a free trial. You fill out the little form back there for our raffle. Just check the box. You'd like a market intelligence trial, and I'll set you up. We also do educational events, 40% off, better deal for Farm Bureau on that. These are just examples of some of the things, like a fertilizer deal. If you have a specific interest in that, you would maybe want to attend. And with that, that was the end. You made it. So once more, I send out a daily morning update I'd be happy to share with you. And a couple times a week, I do a video chart analysis where we go in, we look at the price charts, what they're doing, and what the technicals are telling us on the price charts, what the commitments of traders updates are. We talk about that. And, we talk about whatever marketing strategies, ideas are out there that week. So I would definitely encourage you, please sign up for a trial if that's of interest. Again, on the form on your way out. So that's all I got, guys.
All right.